Hey, hi guys, and welcome back to another episode of the podcast. I am your host, Irene. As usual, share, like, and subscribe. Today, well, we have a couple of episodes that we shot with different guests. We're going through the editing. I don't know what's been going on with the internet lately because a lot of the apps are failing, and I'm not sure why. So we've had a bit of a delay on the episode that was meant to come out today, for editing and uploading reasons. But in the meantime, I'm going to be speaking to you guys about finance because obviously that's my number one passion. And as much as I'm bringing people on, I'm still, going to be talking to you guys about finance on like a one-to-one basis because it's essentially why I started doing this. It's what I love. It's where I'm going. So I'm going to take you guys along with me. I'll still give you that useful content that you do want to hear. So let's get on with today's episode. We are basically covering what's happening in the stock market at the moment, right? You may have heard of the market being overvalued, and you're thinking, well, if the market is overvalued, is it a good time for me to invest? What does it mean by it's overvalued? How do people even assess if a market is overvalued? I'm going to touch on that, and I'm going to touch on some of the solutions that I think might be worth considering if you're somebody who's in this position and you don't really know what to do. Okay, so the first thing is when people say the market is overvalued, I want us to be very careful in terms of listening, right? We have to be very intentional with what we're listening to and don't just react off of the market is overvalued, okay? Listen to what they're saying. Are they talking about a specific market in a specific region? Are they talking about the market in the context of a specific industry? It's really important to understand these things or a particular asset class because it's essentially going to be the reason why you make decisions on your investments. It's going to drive your thesis for the rationale behind your investment. So really pay close attention to what the media says and how they're saying it and in what context it can be applied. Now, personally, I've heard that the market is overvalued. Overvaluation basically means if I have, trying to think of some, if I have an orange, for example, and the orange is valued at £1, right? And tomorrow the orange is valued at £1.20. And it keeps going for £1.20. And guys are like, hey guys, no, this is not right. Oranges have historically been £1. Like we checked everywhere. All the other markets are selling oranges for £1. There's nothing in the farming industry that says oranges should be more than the pound because no costs have increased anywhere else. So fundamentally, we're being sold oranges at a price that is higher than what it should be. So the fundamental price is the sort of basic price. When you do the maths, 1 + 1 = 2. That's the fundamental price. When you're talking about the stock market, the fundamentals are basically like the basic building blocks of the company. So think about the financial statements, the income statements, balance sheets, cash flows, all the numbers of, the activities in and out of the business from a financial sense are printed and provided to you, right? That's the fundamentals. And when you do the maths based on the fundamentals, it will tell you whether this company should be valued at £5 or whether it should be valued at £10. Now, if the fundamentals and, the books say that this company is worth £5, and then the market says, well, we're going to be trading at like £15 because we said so. You get to a point where it's no longer justifiable for the market to continue with the we said so, right? Because the market is essentially what we call an efficient market. There has to be a process where the market corrects itself and brings itself back to that place of efficiency. So this is what we call a market correction, right? Where the actual value of companies based on the books says X and the market says, no, this is where we are. So this here is something that needs correcting, right? So we need to sort of like bring this down a little bit to get the market value correct. So the process of that coming down is called the market correction. Now, the market correction tends to happen in, I guess, a place where it's between 10 and 20% is what we call the correction. So the prices will drop by 10 to 20%, right? And once you've got to the sort of the fair value, which is like the true value based on the books, then the market then begins to do what it does and the stocks begin to increase in value, the companies begin to increase in value, and then we're beginning another market cycle altogether, okay? So with that said, what do you do as an investor who wants to invest when the market is overvalued? There's a couple of things here. The first thing that you will not do is you will not time the market, okay? Because timing the market essentially means that I'm waiting for it to drop, right? And once it drops to a very, very like its lowest point, I'm going to put my money in and then I'm going to invest and I'm going to win. I'm going to make some good returns. That's not how it works. If you think about time in the market and what has been written in like so many reports and different bits of research, we find that timing the market is only successful over specific days, right? So if you look at, say, for example, the last 10 years, if you time the market, only specific days within that correction period would have been a suitable time for you to invest to be able to get the gains that you're looking for. So if, say, for example, over the last 5 years that we've analyzed the market and we're saying if somebody was to time the market, the best entry points would have been perhaps June 19th, 2023, September 17th, 2022, you get specific days. And had you invested in those specific days, you would have been able to successfully time the market. Then it means you're essentially gambling, right? And with gambling, it's like you either win or you lose. So we're trying to get out of a situation. I mean, winning is great. And so if you're in a position where you could win or lose, the reason why we don't encourage for you to behave in that way is because as much as you can win, you can lose. And the wins are great, the losses are not so great. So you don't want to be there at all. You don't even want to play around in that space. Okay. So what do? You do what we call the dollar cost averaging or the pound cost averaging or the Kenya shilling averaging, whatever currency averaging you're doing. So the way this works is that you have, say, some funds that you want to invest, perhaps 10,000 units of currency, whichever country you're from, and you want to invest over a 12-month period. You don't take the whole 10K and dump it into the stock market, because that means you're limiting yourself in terms of the price at which you can enter the market, and that might be detrimental to you. So when the market is overvalued, or it's sort of like at a boiling point, then you're going to be buying at a very high price. So what you do is you consistently, month after month, sometimes it could be weeks, sometimes it could be months, but throughout the year, you want to take points where you're consistently feeding your money into the market and making different investments. So if you look at your investments over a life cycle, you'll be able to see that actually on average, I've been able to buy my investments or purchase investments at a price that's fairly reasonable, right? It's not too high, it's not too low, it's like at a really good point, sort of midpoint. And then from there, you can begin to build. Okay, so once you've done your dollar cost averaging, that's a great place for you to be. Even when you think the market is overvalued, keep your dollar cost averaging going, and you should be okay in the long run. We're not looking at investments that are sort of short-term investments. We're more like long-term investors. If you're looking at short-term investing, there's different securities you can invest in for that. Okay, right. The next thing is this. When it comes to the market being overvalued, we need to listen. Are they speaking on the market from a geographical perspective? And if that's the case, which geography are they speaking about? And then once you get down to the geography, which industry are they speaking about? So we've talked about the GICS classification before. I'll share a link to the video. And essentially the GICS classification is basically an industry classification that classifies every single company into 11 industries altogether. So you could have things like financials, telecommunications, banking. The list is, it's 11 different industries. So technology, when they're speaking about overvalued, are they speaking about specifically the tech sector? Are they speaking about the banking sector? Which industry are they speaking about? And then once you know that, you can look at your investment portfolio and see how you're spread out across those different industries. Now, diversification is key. Okay, first of all, regional diversification, because when we get down to the industry, say, let's speak about tech stocks, for example. So tech is very heavily US-based and Asia-based. Now, if they say the tech industry is overvalued, it would mean that the American stocks and the Asian stocks might be suffering from that quite a bit, right? And so if they're overvalued, you might potentially want to think about looking into other industries or other regions, right? But America and Asia do not only focus on tech, they focus on a variety of other industries within that 11 sort of gigs industry framework. So it's important to have that in mind as well. So let's think about the S&P 500. We've got 500 different companies on this one index, right? We know that 7 of those companies, the Magnificent Seven, make up the tech industry, and they make up 33% in terms of valuation of the S&P 500. And we've got like a 400 odd companies plus dominating the rest of the index. And so when the S&P 500 is overvalued, you're essentially very heavily skewed towards tech stocks. And where a tech stocks are generally listed, they are on the NASDAQ exchange, right? If you look at the NASDAQ 100, this is where you'll find a lot of tech companies. It's a very innovative space. It's a bit of a volatile space as well because, you know, tech is fairly like, it's not new, but like in terms of what the market is doing, is like it's fairly new. So no one really knows what's happening. Okay. So the NASDAQ 100 is going to be spread across different types of indexes, ETFs, and whatever, right? However, you want to look at stocks that are also listed in different exchanges that have nothing to do with the NASDAQ, which is then going to cover the other industries within the GICS classification. And so when you're looking at banking, you're looking at telecommunications, when you're looking at all the other different industries, these tend to be fairly like stable industries, right? I mean, banking has had its crisis, you know, once in a while, every now and again. But on average, there's companies that tend to be very reliable and steady. If you think about the dividend aristocrats, which we've spoken about before, these companies tend to pay out steady and consistent dividends, which means their books tend to be fairly steady in terms of the valuation. Chances of them being significantly overvalued are not really high. So you might want to look at maybe European stocks because they tend to be fairly stable and steady. You want to look at, in America, you want to look at the industries outside of tech and see how they've been performing, see, you know, listen to what they're saying about the valuations there. And then obviously, if you're somebody who's in the S&P 500, it's just for you to really understand, do you want to realize some of those gains? And by realizing a gain, it means you're cashing in on the gains that you've made, keeping your original investments in there or some of the investments in there, and then holding on to that cash for when the market then sort of corrects itself, then you can go back in. Additionally, you can take that cash and put it into the bond market, okay? So diversification from an asset class perspective is also another thing you need to look at. So what happens with bonds when the interest rates are high and inflation is essentially an issue? The value of the bond yield will be high, the value of the bonds will be low, right? And to put it simply, without talking about yield and whatnot, let's just put it this way. When interest rates are high, it means that bonds are being issued with high interest rates, which means it's good for investors because you do want to get high interest on your investments, right? Which means that older bonds are then going to be not as attractive because they had lower interest rates. So you might find people realizing their gains from the overvalued section of the industry and putting that money into bonds, not necessarily holding it out as cash, but they might put some in cash and then put some into bonds because bonds are giving a more attractive return, a more, not even attractive, it's more of a reliable, steady space to be in, right? So that might be something that is worth considering for you. Once you've done that, so you've considered diversification, you've considered perhaps diversification by industry, geography, and asset class. Then we've talked about cash. You might take out some cash, realize those gains, and hold that cash because you want to watch what the market is doing and get in at some point. Now, what I will say is this is what it kind of plays in the element of timing the market because you want to invest low and sell when it's high. So what Warren Buffett has done, he's like an investment guru. If anybody knows about him, he's like the OG of investing. He's holding cash right now because he's waiting for an opportunity for the market to drop and then he can go in and have that liquid cash in hand so he can make some investments at a bit of a lower price. He's not going to be timing the market per se to say like, oh, you know, it's gone, this is the lowest it's going to get. No. When the market begins to drop, you also want to do your dollar cost averaging or your pound cost averaging and start investing at different points, because you never know when it's going to shoot up straight away. And what you don't want to do is be out of the market when it begins to now make that steady rise, so you can have your investments increase in value over time. Okay, I hope that explains to you some of the things that you can do or you can think about as an investor when markets are reported to be overvalued. Think about the industry, think about the geography, think about the asset class, perhaps even think about bonds, think about holding some cash as well. So you can also think about buying when the prices begin to go down. And overall, I mean, for long-term investing, you should be in a place where you can get some really good returns from your investments. So don't panic. Don't sell everything and stay out of the market. It's also not advisable to do that. Take what I've said, do your research, and then figure out what works for you and your portfolio. And hopefully you can make some really good decisions. I guess thank you for joining me today, and I will see you next time. Bye for now.